We'll now discuss corporations. A corporation is a separate legal entity formed under state civil law that is owned by shareholders. A corporation is generally taxed under Internal Revenue Code, Subtitle A, Chapter 1, Subchapter C, unless it elects to be taxed under Subchapter S. Corporations taxed under Subchapter C, normally known as C corporations, are taxed annually on their earnings, and the shareholders are taxed on these earnings when distributed as dividends. A corporation must register with the California Secretary of State before conducting business operations and file appropriate paperwork. The Secretary of State issues the corporate identification number used when filing California corporation returns. Key features of a C corporation are that it has the option of choosing an income year rather than a calendar year. They must create bylaws, that is, how the corporation will operate, that establishes stockholder meetings, director meetings, number of officers, and their responsibilities. The owners are not liable for the losses of the business. Creditors may only look to the corporation and the business assets for payment. A corporation requires a separate bank account and separate records. Owners have ultimate control of the corporation, but must elect directors who in turn elect officers for the company. The directors make the major decisions, while the officers make the day-to-day decisions. The life of the corporation is perpetual in nature. Ownership is easily transferred through the sale of stock. New owners can be added by the issuance of additional stock. The ownership interests for entities that are not civil law corporations are generally treated as shares of stock for tax purposes. Corporations are more costly to set up and to maintain than a sole proprietorship or a partnership. Consult an attorney for guidance to set up your corporate entity. C corporations that organize, register, conduct business, or receive California source income must file California Form 100, California Corporation Franchise or Income Tax Return. Other entities that elect to be taxable as a C corporation must file California Form 100 if they receive California source income. A C corporation is taxed on its net income at a tax rate of 8.84%. Entities formed as corporations under civil law and LLCs that elect to be taxable as C corporations are subject to a minimum tax of $800. The $800 minimum franchise tax is due the first quarter of each accounting period and must be paid whether the corporation is active, inactive, operates at a loss, or files a return for a short period of less than 12 months. The minimum franchise tax is waived on newly formed or qualified corporations filing an initial return for their first taxable year. The return due date is the 15th day of the third month after the close of the taxable year. Estimated taxes are due and payable on April 15th, June 15th, September 15th, and December 15th. See instructions for California Form 100ES, Corporation Estimated Tax, for additional information and applicable rates. Corporations must complete Form 100ES to report their estimated taxes. Shareholders may be required to pay estimated taxes for their own reporting purposes. An S corporation is a corporation formed under state civil law or any business entity, such as a partnership or LLC, that elects to be taxable as a corporation for tax purposes, that elects under federal law to be taxed under Subchapter S. An entity that has elected to be taxable as an S corporation for federal tax purposes is also treated as an S corporation for California tax purposes. The S corporation must register with the Secretary of State. An S corporation generally offers liability protection to its owners or shareholders and is a conduit where the profits or losses flow down to the shareholders, partners, or members. The owner's liability for debts and obligations depends on how the S corporation is formed under state civil law, that is, corporation, partnership, or LLC. An entity must elect to be treated as an S corporation and is limited by the types of owners not to exceed 100 shareholders. Shareholders can only be individuals, estates, or certain trusts. An S corporation can also own subsidiaries. Key features of an S corporation are that an S corporation does not pay federal income tax. An S corporation under California law is subject to a 1.5% tax on its net income and is a conduit similar to a partnership. The items of income, deduction, and credit flow down to each shareholder through Schedule K-1, shareholder's share of income, deductions, credits, etc. Each shareholder is responsible for paying taxes on their pro rata share of the S corporation's items of income, deduction, and credit. The shareholders are not liable for the losses of the business. Creditors may only look to the corporation and their business assets for payment. An S corporation requires a separate bank account and separate records. An S corporation that organizes, registers, conducts business, or receives California source income must file California Form 100S, California S Corporation Franchise or Income Tax Return. The S corporation must provide each shareholder with the Schedule K-1 that states the shareholder's pro rata share of the S corporation's items of income, deduction, and credit. The return due date is the 15th day of the third month after the close of the taxable year. An S corporation is taxed on its net income at a rate of 1.5% for the California purposes. S corporations are not subject to income tax for federal income tax purposes. S corporations that are corporations or LLCs under civil law corporations must pay the annual $800 minimum franchise tax. The estimated taxes are due and payable on April 15th, June 15th, September 15th, and December 15th. See California Form 100ES, Instructions for additional information and applicable rates. Corporations must complete Form 100ES to report their estimated taxes. Shareholders may be required to pay estimated taxes for their own reporting purposes. Now we'll talk about a limited liability company. An LLC is a newer form of business entity. It can be classified as a partnership or a corporation. For California income tax purposes, an LLC with more than one member will be classified as a partnership, and an LLC with a single individual member will be classified as a sole proprietorship, unless the LLC chooses to be classified as a corporation. To be taxed as a corporation, the LLC files an election form with the Internal Revenue Service. For income tax purposes, California treats the LLC and its owners in the same manner the LLC is treated for federal tax purposes. Some key features of a limited liability company. An LLC may have one or more owners in different classes. In addition, an LLC may be owned by any combination of individuals or business entities. An LLC that is taxable as a partnership can achieve both conduit tax treatment and limited liability protection under civil law, similar to an entity taxable as an S corporation. However, an LLC taxable as a partnership does not have the ownership restrictions that apply to entities taxable as an S corporation. If the LLC has a single member, it will be disregarded as separate from its owner and will be treated as a sole proprietorship or a division of its owner, unless it elects to be taxable as a corporation. In general, all the owners or members are shielded from individual liability for the debts and obligations of the LLC. An LLC is formed by filing articles of organization with the California Secretary of State prior to conducting business. Forming an LLC is simpler and faster than forming and maintaining a civil law corporation. LLCs do not issue stock and are not required to hold annual meetings or keep written minutes, which a corporation must do in order to preserve the liability shield for its owners. Either before or after filing its articles of organization, the LLC members must enter into a verbal or written operating agreement. A formal written agreement is advisable. An LLC is typically managed by all its members, unless the members agree to have a manager handle the LLC's business affairs. Generally, members of an LLC that is taxed as a partnership may agree to share profits and losses in any manner. Members of an LLC that is classified as a corporation receive profits and losses in the same manner as shareholders of a corporation legally organized as such. An LLC's life is perpetual in nature. However, the members may agree to a date or event of termination. All LLCs which are classified as corporations and organized in California, register in California, conduct business in California, or receive California source income must file California Form 100. The California Form 100 must be filed by the 15th day of the third month after the close of the LLC's taxable year. The LLC will be taxed at a corporate tax rate of 8.84% and will be subject to a minimum tax of $800. The filing requirements of an LLC classified as a partnership or a disregarded entity are: all LLCs which are classified as a partnership or disregarded entities and organized in California, register in California, or conduct business in California must file California Form 568, Limited Liability Company Return of Income. Form 568 must be filed by the 15th day of the fourth month after the close of the LLC's taxable year. An LLC required to file Form 568 pays an annual tax of $800 and may be subject to an LLC fee based on total income from all sources derived from or attributable to the state of California. The annual tax is due by the 15th day of the fourth month of the taxable year and is paid using FTB Form 3522, Limited Liability Company Tax Voucher. The estimated LLC fee is due by the 15th day of the sixth month. In addition, an LLC filing Form 568, which has members who are not residents of California, must file FTB Form 3832, a Limited Liability Company Non-Resident Members Consent Form, with Form 568. FTB 3832 is signed by the non-resident individual and foreign entity members to show their consent to California's jurisdiction to tax their distributive share of income attributable to California sources. The LLC must pay the tax for every non-resident member that did not sign an FTB 3832. Estimated tax for a limited liability company. If the limited liability company is classified as a corporation and files Form 100, the following estimated tax guidelines apply. The estimated tax is payable in 4 installments. See California Form 100 ES instructions for additional information and applicable rates. Installments are due and payable on April 15th, June 15th, September 15th, and December 15th. Corporations must complete California Form 100 ES to report their estimated taxes. Additionally, members may have to make estimated tax payments for their own reporting purposes. If the limited liability company is classified as a partnership or disregarded entity and files California Form 568, the following estimated tax guidelines apply. Estimated LLC fee is due by the 15th of the sixth month, and members may have to make estimated tax payments for their own reporting purposes. The LLC treated as a partnership may be required to withhold taxes if the partnership distributes California's source taxable income to a non-resident member. For more information about partnership withholding, see FTB 1017 Resident and Non-Resident Withholding Guidelines. For additional information, go to ftb.ca.gov or call 800-852-5711. For general information about our small business taxes, go to taxes.ca.gov or call the Small Business Liaison at 916-845-4669. Our brochure, the FTB 1123 Forms of Ownership, contains much of the information from this presentation.